In this opportunity, we are going to talk about growth determinants. Several aspects regarding terminal value perpetuities were discussed in previous videos. In particular, we talked about the relationship between growth and reinvestment. We also have discussed the impact of exchange rates when we are dealing with weak currencies, the extension of the cash flow projection, what we call the horizon, and the weight of the terminal value in total firm value. This video will cover the determinants of the growth rate itself. Let's first examine 4 possible scenarios for the growth rate and its corresponding implications. First, let's assume a zero growth rate, that we assume a zero growth rate. Well, if we have a zero growth rate, it means that if inflation is positive, it means that we are declining in real terms, that there is a gradual decline in real terms. And the implication, of course, is that we are liquidating the business gradually. This might be realistic in some cases, but in general tends to be a pessimistic scenario. Second possibility, say that we assume that we grow with the inflation rate. In this case, if we grow with the inflation rate and the economy is growing in real terms, it means that we have no real growth, no value added, and probably if our market is growing in real terms, we are losing market share. Another possibility is growing with our market at the same growth rate of our market. In that case, of course, we keep our market share. And another possibility is growing at the long-term economic growth rate of the economy as a whole. This is a possibility, but what is true is that in terms of a perpetuity, meaning in perpetuity forever, okay, assuming an economic a growth rate which is larger than economic growth would imply that our business grows at a faster pace than the economy as a whole. So at some point, our business will be larger than the economy, which is absurd. So our first conclusion here is that no company can grow in the long term at a rate faster than long-term economic growth. Let's get deeper into this idea of long-term economic growth for a company. As we said before, in principle, the maximum possible long-term growth rate equals long-term economic growth. However, a firm growing at the long-term growth rate of the economy is still adding value. For instance, if the economy is growing in real terms, meaning that long-term economic growth is larger than the inflation rate, and a firm is growing at that same rate, it means that the firm is growing also in real terms. So that the firm is adding value, is all the time investing in perpetuity, is investing in positive net present value investments. Well, given that this is impossible, that no firm can add value in eternity, growing at the economy's long-term growth rate is feasible only during a certain number of years, but not in terms of a perpetuity. Hence, in reality, the maximum growth rate of the perpetuity equals the inflation rate. In no case, the perpetuity can grow at a rate faster than inflation, as we explained in a previous video. Now let's get deeper into the relationship between reinvestment and growth. Recall this formula that we explained in a previous video. Here we say that the growth rate of the economy in nominal terms, capital G, is equal to B multiplied by ROIC plus 1 minus B multiplied by pi, where B is the plowback ratio, meaning the proportion of our cash flow which is reinvested in the company in order to grow. ROIC, we know that ROIC is return on reinvested capital, which is the return that we get on our investment, and pi is the inflation rate. Well, we know that long-term growth rates are bounded by inflation, as we said before. But yes, long-term growth rate G is bounded by inflation. But what bounds ROIC? Okay, ROIC is bounded. What determines the value of ROIC? Well, ROIC is determined by the competitive advantage of the company we are dealing with. What is true is that given that long-term nominal growth rate can never be larger than inflation, then in perpetuity, no company can have a ROIC which is larger than WACC. In perpetuity, no company can add value in real terms. So ROIC at some points is eliminated. Okay, this competitive advantage at some point is eliminated. Let's get deeper into what determines ROIC. Well, using a reference from the book Valuation by McKinsey, we can say that ROIC can be analyzed in three ways. First, the value of ROIC depends on the length of the product cycle. For example, if we are dealing with a particular product, this product has a period of time in which it yields positive returns larger than WACC, okay? And at some point that is eroded, that is eliminated. For instance, Microsoft is the prevailing platform and has been the prevailing software platform for many, many years. So in this case, we have a product which has a very long cycle. Other products have shorter cycles. But as long as Microsoft remains the prevailing platform, well, this company will be taking advantage of this, and we will have a growth rate which is positive in real terms. The second is the persistence of competitive advantages. Companies are developing competitive advantages all the time, at least successful companies, okay? But what is true is that because of competitive reasons, as soon as a company develops a competitive advantage, other competitors try to imitate these competitive advantages or try to develop products which erode away these competitive advantages. So the question is, for how long a company can sustain a particular competitive advantage? And the last one is the potential for product renewal. Okay, some companies are very able to reinvent themselves. Okay, when they see some products losing competitive advantages, so that the company is losing the ability to produce positive net present value investments, so these companies transform themselves and invent new products or new ways to do business. We have two examples down here. One is Apple Computer, which has been very able to invent new products all the time and get into new types of doing business all the time. And Procter & Gamble, which is a centenary company, more than a century old, which has been very able to keep up front in his sector by renewing itself. Also from this book, Valuation, we have this interesting table in which we see the level of ROIC, for different industries in the United States. For instance, we see that for these sectors, pharmaceuticals, software, IT services, we find the largest ROICs, okay? Whereas for these other sectors in the other extreme, paper and forest products, integrated telecoms, electric utilities, and airlines, they have the lowest ROICs. And this corresponds to the period between 1965 and 2007. Also, from the same book, we find that there are some sectors in which ROIC is increasing. They mention healthcare, equipment, aerospace, and defense, and other sectors in which ROIC is going down, like trucking, advertising, healthcare facilities, and automobiles. So, what can we conclude about all this? Well, first, a firm's long-term growth cannot be larger than long-term economic growth. Second, no firm can add value in perpetuity. Thus, in reality, the growth of the perpetuity cannot be larger than inflation rate. Third, ROIC is the main determinant of growth. And lastly, the magnitude of ROIC depends on the characteristics of the product, but also on the ability of the firm to preserve its competitive advantages or the ability to reinvent itself. And that is all I wanted to share with you in this opportunity.